Welcome to the Market Signals podcast. Adam Turnquist here, Chief Technical Strategist at LPL Research. Excited to host the call this week, but even more excited to introduce Will Thompson as our guest. Will's the founder and managing partner of Massif Capital, a long-short hedge fund focused on liquid real assets. Prior to starting Massif Capital, Will served as a co-portfolio manager, running a portfolio of credit and political risk insurance policies for Chaucer, a Lloyd's of London insurance syndicate. He also served as an economic advisor for part of NATO in Kabul, Afghanistan, and was a flag writer for a senior military commander. I had to Google what a flag writer was. Maybe Will can share some more insight there. He did graduate from Trinity College and also holds a master's in government from Harvard. Will, welcome to the show.
Thanks for having me.
All right. Well, you came highly recommended from our research team. I had reached out to them asking for really, who do I need to talk to for deeper insight into what's going on into the commodity markets in real asset universe? But before we dive into the markets, let's get a little bit more background, which, as I outlined in your bio, is, I think it's fair to say, unusually diverse. Just curious how your past work experience helped really shape your view on global markets and understanding of geopolitical risk.
So I think, the beginning of my career was pretty normal. It was private equity, investment banking, pretty normal finance stuff. I did the investment banking internship route out of college. I did it when it admittedly wasn't terribly competitive. I talk with guys now or kids now basically leaving college, and I don't think I would have gotten a job. I had to compete with these kids. Then it got a little more diversified, I guess, towards the middle of my career. I think that the value, the challenge with finance, of course, is that a consensus viewpoint is a mixed bag, right? It's if you follow some trend and momentum, a consensus viewpoint can work for a while, but a contrarian viewpoint also needs to play a role at some point. And if you've got the same career and had the same experiences as everyone else, it makes it a little hard to have that outside viewpoint. And my career was not, didn't follow an obscure path solely for that reason. But it was a happy benefit, I guess. And to that, I'd add that I thought I was going to go into finance in college. And I had everything sort of lined up with internships and things like that. So I also was a philosophy major in college. So I chose to study something that my peers didn't. And then with grad school, which was 2008, 2009, 2010 period, or I guess 2009, 2010 period, everyone was going back to business school. I mean, because of the great financial recession, if you will. And I did choose deliberately to do something different there because it seemed like everyone was going back to do the same thing, which just seemed counterintuitive. I think, though, the international experience and specifically the international experience in a very different way, first with NATO ISAF and Kabul as you said, sort of quote unquote flag writer, which is really just a general's research assistant, and as an economic advisor, presented me with a very unique perspective of what it takes to build an economy, and more importantly, perhaps, how politics and economics are so interconnected. That insight, which barely qualifies as an insight, that sort of general, if you will, which everyone would sort of nod their head and say yes to, I actually attribute to a lot more of my success than people might imagine. Politics and economics are intimately related, intimately intertwined. And while we did experience a period of time in the sort of post-Cold War era where it seemed like they were separate subjects, very much siloed, I think that was an aberration. rather than the state of sort of the general operating sort of paradigm, if you will. And I think that those lessons related to that lesson and lessons related to that were picked up very much in that period of time where I was managing political risk, insurance policies, and that time in Afghanistan, where I was actually in this sort of broader effort to try and build the economy, but very much from the government side, if you will. And so, that interrelationship is critical and probably the most important takeaway from my sort of more diverse background.
Right. Certainly philosophy and investing seem to go hand in hand in today's world where the political environment is very much intertwined into the macro and the economy. The value I'm sure has increased in light of what's going on in markets today. Curious, you go from the security of a job in corporate America or as an economic advisor. What led you to starting your own fund? Was there kind of an aha moment that said, okay, I'm going to do this? Because that's a big leap of faith.
Yeah. So it's actually I think somewhat amusing story. But I've been running the portfolio or co-managing this portfolio of credit and political risk insurance policies for a while. And the companies you deal with are in that business are all the sort of quote unquote liquid real assets I deal with now. So energy companies, and that runs the gambit from traditional upstream, midstream, downstream oil and natural gas, all the way to renewables, and some various idiosyncratic things like geothermal, for example, and utilities. And then there's materials, mining, principally mining, but there's also, chemicals, building products, timber, agriculture, aquaculture, et cetera. And then industrials and infrastructure lumped together sort of at the end. Infrastructure, for us is everything except for airports. So electrical grids, midstream oil and natural gas, toll roads, bridges, those types of things. And then industrials are primarily companies that are the initial consumers of commodities and or service providers. Those are all the same companies you deal with in the credit and political risk insurance world. But what happens in insurance is you've got this nasty asymmetry where if a policy goes wrong in that line of business, you might be on the hook for 10, 15, $20 million in any given year. But you're paid only 1 or 2% of the value of that insurance. So if one policy goes wrong and you're paid 1 or 2% and you're out 20 million, and you're out 20 million, you've got to slap a lot of policies at 1 or 2% in the books in order to offset that loss. And so the asymmetry in the return profile is quite nasty. And because we ran such a clean book, I got a little tired of not participating in the upside.
Yeah.
So I started Massif because I went to 4 or 5 hedge funds that we had relationships with, and they all told me that nobody ever made money in energy and materials, and everyone makes a little bit of money in industrials, but everyone already had some money in industrials. I just couldn't wrap my hands around the idea that there was no money to be made in energy and materials. It just seemed ludicrous. So I quit my job after the 4th interview, where I was told the exact same thing, that nobody makes money here, and said, well, geez, if nobody makes money, I better start a business, because if everyone thinks you don't make money, clearly there's money to be made.
Yeah, talk about applying the contrarian viewpoint on that one. Mm-hmm. In terms of your hedge fund, how would you describe your investment process in Universe, given it is a relatively unique area of the hedge fund industry?
Yeah. So I often, and this doesn't apply to every company in our universe, but I often talk about us investing principally in projects. And that sort of governs a lot of the research process, right? So someone is building something. That something tends to cost, several $100 million to several $1 billion, and tends to take several years to build. That cost will come up front, and then there'll be a cash flow for 10, 15, 20, 50, 40, 40, 50 years, et cetera. And so, we're very much project investors. Sometimes those projects are held by a business, say a Barrick Gold, where there are multiple gold mines. Other times that project is the business. And so approaching what we do from that project lens, where we're always underwriting a project or a series of projects, is sort of the lens through which we conduct our research. In regards to the universe, it's actually a far larger universe than people tend to think. A couple thousand companies. For us, it's a couple thousand companies across every market save for Russia, India, and China, which are three markets we don't invest in for various different reasons. Each one a slightly different reason. But it's a couple thousand companies, and well in excess of I've forgotten what the market cap is now, but it's multiple trillions, which I guess in the grand scheme of things these days isn't that big, given that you have individual companies that are up there, but it's realm of $10 trillion or something. So it's a large market with a lot of things to do.
Right. And lots going on, especially in today's world and the commodity complex. And maybe let's jump into that and just your market views. We'll start with precious metals and gold prices. I looked this morning, and just for a timestamp, it's June 24th, about 10:15 Eastern. Gold down to about 4,000 an ounce, coming well off their January highs, and a bit counterintuitive to a lot of people with gold underperforming since the start of the Iran war. What's your outlook on gold, and how have the fundamentals changed over the last few years from your perspective?
Yeah. So yeah, I mean, back here 4,000, which just as a reminder to everyone, put another timestamp in there. That's where we were in November of last year, and of course, if you go back a little bit further to just say the beginning of 2025, we were at I don't know, thereabouts. So while gold may have sold off, especially this past month or the past 2 months, we're still quite a ways off, various different levels we've reached over the last couple of years. So I would say that, going forward, obviously the interest rate environment and the dollar strength, these are sort of high level impediments to the gold price. But I would probably look to something a little more fundamental to understand what's happening here with the gold price. When one thinks about a commodity, at least in my opinion, one always needs to sort of be thinking about the average sort of cost of production across the entire industry. A commodity can unhook from that level for some period of time, but it's very unlikely to trade significantly above that level for extended periods of time. Now, gold is perhaps an exception to that, and that is because there's a lot of intangible variables associated with gold that allow it to disconnect from fundamentals for longer in theory. But the reality is that, the all-in sustaining cost of gold across the entire industry is well less than $2,000 an ounce. I'd have to update, some math to find out where it currently sits, but, I'd be surprised if it wasn't, say about $1,500 or so an ounce. How long and how high above that can the price of gold stay? And I would argue that, it can stay above that for some period of time, but 5,000 is well above that, and it was only a matter of time before it fell. So my expectation would be that gold remains, at some sort of healthy price relative to that, say, 2024 period, and certainly relative to the say 2023 period. But the idea that it was going to hang out up here in that $4,000 to $5,000 range seems a bit nonsensical to me, unless your assumption is that it has so disconnected from the fundamentals for a very tangible reason that we can all sort of agree on. And I would be hard pressed to figure out what that tangible reason that we can all agree on is. There's governments have debt issues. There's no doubt that there's geopolitical risk out there. These are all things we can agree on in principle. But the value of those things as a risk premium is a much more open-ended question.
Right. Certainly, I think you can make the case fundamentally still a bullish view. And gold seemed to get caught up in this momentum trade last fall. When you look at some of the ETF flows, it was trading more like a momentum stock than a
Very much so.
precious metal. And I think we're seeing some of the unwind of that. And maybe it's a healthy unwind just given the parabolic rally that we've seen. How do you think about operators in the space from a fundamental perspective when you're looking at some of the gold miners? And is there a point in the cycle where owning actual gold makes more sense than, for example, a gold miner?
So I'll take the second part of that question first. In regards to owning gold versus a gold miner, I invest in equities, so I really can't speak to that. That's a preference question, and it would largely be a thesis question. If you can construct a decent thesis around gold's future path, then maybe gold is the way for you to go. If that is the only thing you've got, a thesis around the gold price, then you probably shouldn't be in equities, because equities adds a whole other layer of risk to it. If you have a gold thesis, you invest in gold. I very rarely have a gold thesis. What I said about gold is about as sort of in-depth and nuanced as I'm going to get on the gold price and trying to forecast gold prices. It's not a skill set for me. Forecasting any commodity price is really not a skill set for me. And while there are some managers who are very good, at least on a relative basis, at commodity price outlook, it's a really hard game. Probably no harder than equities, admittedly, but a different skill set, right? And it's not a skill set or that I have, and it's not necessarily part of our sort of general research sort of process. We have a general high-level outlook about directionality over a period of several years, but beyond that, we don't get terribly nuanced commodity price itself. In regards to the equities, I mean, as I said, I think and again, I've got to double check these numbers and someone can correct me. I think the average all-in sustaining cost across the industry is well less than $2,000 an ounce. That means that, anything above 3,000 and everybody's minting money. Now, admittedly, there is some compression, let's say, on inflationary costs, especially, with diesel cost inflation and things like that passing through. But I mean, in the grand scheme of things, if again we're talking about a all-in sustaining cost of production less than $2,000 an ounce, our margin on anything above 3,000, even including diesel inflation and things like that, is spectacular. So a lot of the gold miners, especially given this move off of the highs set in February, March, they're starting to look quite attractive. I've got gold miners in my portfolio that are going to have free cash flow yields, in the I don't know, I mean, well north of 15%. So I'm not sure what there is to complain about with gold miners.
Yeah, it sounds like some good economics from that perspective. You mentioned dollar in yields having a material impact on the gold trade right now. Do you have any views there, and maybe the dollar diversification trend we've heard so much about?
Yeah. have nothing really to say on interest rates per se. I mean, watch it the same way everyone else does. I wouldn't claim any particular insight into the future path of interest rates. I myself was just sort of from a more philosophical perspective, pleased to see that we might be pulling back a little bit on this idea of forward guidance from the Fed. It's not clear to me that one thing that seems to have happened is that with forward guidance, ever more of the market has become intimately tied to those forecasts and those outlooks. And given that interest rates affect everything, I don't think that that makes sense, right? Like if they're going to provide forward guidance out of the Fed, and it does impact everything, then paying attention to that forward guidance makes sense. At the same time, it has perhaps, and I have no evidence to support this. This is just an inkling I've got. Perhaps prompted everyone to focus unduly on that variable and not enough on, say, in the case of equities, fundamental research about the valuations of companies. And so, at least from my perspective, pulling back on that forward guidance makes some philosophical sense, and I was pleased to see that is sort of the path that Kevin Warsh appears to be taking. I also am not terribly confident that interest rates should be lower. It seems to me they should be higher. So the fact that they didn't cut, was a positive in my mind. In regards to dollars, I think the general the data that I have seen suggests that yes, some people are cycling out of dollars at the margin. But this, broad-based de-dollarization is a bit of a headline that's been oversold, it seems like. Is there, some movement out? Absolutely. There's no question about that. But the dollar is such a dominant force that, we're talking about, incremental percentages here rather than, say, a wave. And I do tend to think that the headlines sort of suggest or imply in their sort of bombasticness that there is a massive move out of the dollar. And I don't think there's ever been any evidence to support that. There's just been evidence to support some marginal movement. So,
right, dollar still king when you look at some of the data points, and when you think about alternatives. The TINA rule applies in terms of there is no alternative when you look at competing currencies out there. Let's switch gears a little bit to the industrial metals. I read through your Q4 letter to investors, which anyone listening, I highly recommend reading. Super insightful and a refreshing view on the macro landscape. But you outline copper miners and developers as the single largest investment theme. Walk us through your thesis on the copper miners and why they are the largest single investment theme from your perspective.
Yeah, and just for clarification, when I say the single largest investment theme, that was the single largest, investment theme in our portfolio. It clearly, obviously, is not a bigger theme than, say, AI or something from a dollar value perspective. But within our portfolio, it is a large exposure, and I mean it comes down to a couple of variables, but first and foremost being how difficult it is for a management team to actually build a copper mine. Building a copper mine has gotten really hard. There was a time where, if you think about mines, you could think about, say, the geology and the complication of geology, and then the infrastructure associated with mining that asset. And these things sort of ran in opposite directions. So a diamond mine is very complicated, but you don't require a lot of infrastructure, if you will, because you could just put the diamonds in a suitcase, put the suitcase on a helicopter, and you could fly the diamonds out. So really, but infrastructure is relatively simple. On the other end, you have something like, say, iron ore in Australia. Iron ore in Australia is red dirt that they just scoop off the ground, but they had to build a freaking train system to get it out of the country, right? Trains, ports, etc. So geology, very simple. Infrastructure, massive. What's happened with copper mines is that copper mines have had to get bigger. And as a result, the infrastructure around them, the cost of building them has exploded, while at the same time, the geology's gotten more complicated. So rather than these things sort of running in opposite directions with copper, they've run in the same direction. And that same direction is just to make it harder. And so from a dispersion perspective, what is the results of everyone in the industry going to look like? And that has created wider dispersion. There are people who will do it better, and there are people who will do it worse. Anytime we see that wide dispersion or an opportunity for growth in dispersion as a result of operational variables, that's an opportunity for us to come in as stock pickers and really add value, sifting between those management teams who are going to be capable of executing this extremely difficult task and those who are going to bungle it. Now, those who bungle it may still succeed. They may get a mine at the end, but it's going to be a much rockier road and your return isn't going to be as high. And so, a lot of the thesis with copper hinges first and foremost on the fact that increased dispersion creates an opportunity for management teams and companies and asset owners to really show the market their skill set and how unique they are. And so we view copper as this sort of great metal to find great assets and great owners in. In addition to that, you have this macro backdrop, which is favorable, but is, from our opinion, insufficient in and of itself to invest in copper. You need, if you're investing in copper miners, I should say, the copper miner story needs to stand on its own, absent that macro. But the macro thesis, can be summed up as the average grade of global copper mines has fallen precipitously over the last decade. The difficulty in finding copper mines has increased significantly over the last decade. The number of massive sort of quote unquote tier one deposits that you need in order to sort of continue to grow copper supply globally has harder. The number of mines that produce 500,000 or so tons of copper a year is very limited, and they've gotten increasingly difficult to find. And with that, the incentive cost to build a copper mine has increased. What the incentive cost across the industry is to build a mine, that's not a number that is a sure thing. That's an inferred number you get from a sort of talking broadly with management teams and looking at the supply curve and things of that nature. But I would be surprised if the real incentive cost to build a copper mine isn't something like $5 to $6, somewhere in there. And yes, there are probably some mines somewhere where you do have a lower incentive cost. But again, the difficulty of building the mines has increased, and the number of mines that one sort of wants to build has decreased. So it's going to tilt that incentive towards the higher end of that price range. And that's, to be perfectly frank, we're looking at copper right now today at, about $6 a pound. So we're only really at that incentive cost. And so it's a really interesting backdrop to be investing in copper.
And I imagine the AI story has changed the supply outlook. You mentioned how complicated it is to get copper out of the ground. It's a big time commitment, a big capital commitment. How much has that changed your outlook on just the broader copper space as it relates to copper miners as well?
Well, I unfortunately somewhat bemoan the fact that some of the things I invest in copper metals more broadly have gotten caught up in the AI trade, if you will. I think it's a bit tangential, but there's sort of a genuine linkage that has occurred as that trade has spread out, and as a result, of course, say the last couple of weeks have been a little rough because there's been a bit of a sell-off in the copper space and some of the other, let's call it AI related metals with the AI and semiconductor volatility. I think that it hasn't changed my outlook. Even if we were just to not grow copper demand, we're still not putting into production enough new mines to sort of keep up with existing demand. It's not like oil and natural gas, although I'd have to look at oil and natural gas over the last couple of years, but at least historically, you've wanted your oil company to replace 100% of its annual production yearly with new discoveries. That's not where copper mining is at, right? We're below that. I don't know where below that we are, but we're absolutely below that. And so it's not just a growth question. I don't really like investing into these growth thematics. What I do like is investing into situations where if nothing changes, we still have a problem. And that's where we are with copper. If nothing changes, we still have a problem. We actually need to see copper demand fall in order for the sort of business as usual case to be sufficient to meet our demand. That seems improbable because copper just grows with the economy. If the economy continues to grow, copper demand is going to continue to grow. And so, any time where the macro case is business as usual is not going to be sufficient to meet business as usual demand, that's an interesting situation. AI adds some potential growth, but who knows what it is? It's very hard to judge. So, but again, I do somewhat bemoan the fact it's been caught up in that trade because it's added some volatility and momentum to it that has made the underlying stocks disconnect a little bit from the fundamentals. And one of the things I do like about our industry is that or these industries that I look at is that the stocks do tend to stick towards the fundamentals. They trade around them volatilely sometimes, but the fundamentals do act as a very meaningful and real anchor that in, say, an industry like AI or semiconductors, you just don't have quite as much of. I guess in semiconductors, you used to have it with quite a bit of cyclicality, but tech more broadly, you don't have that anchor or quite as obvious, at least.
Right. Seems like one big AI trade for the market right now. And I like your point about AI or no AI, supply side still a problem for copper. You look at some of the supply demand forecasts 2 years ago, 3 years ago, and it was really telling basically the same message. Let's switch it up to energy. Obviously, a major driver of risk appetite and volatility this year. We've seen oil prices come in materially on seemingly a peace agreement. We'll see how that plays out over the next 50, 60 days here. Just curious your thoughts on energy markets and oil and this idea in the market. It seems that supply is going to normalize as the strait reopens. How are you thinking about that?
Yeah, so I guess what I would say, having worked fairly closely with hull insurance organizations when I was at Lloyd's, it is not the politicians that will decide when the Strait of Hormuz is open. It is the insurance companies that will decide when the Strait of Hormuz is open. And at the moment, the insurance companies have very much decided the Strait of Hormuz is not open. That is in part why you see 16 to 24 odd tankers a day leaving the straits, and not a flood, and certainly not the. I think Donald Trump said a couple of days ago that 700 ships left the Persian Gulf, which of course would be something in the realm of 10 times the average daily volume prior to the war in Iran. So my guess is that we're going to get a short-lived flood of oil here. The paper oil market, which is 10 times the size of the physical traded market, is going to wag the tail, or is going to be the tail that wags the dog for a little while. And then fundamentals will reassert themselves, and the fundamentals are that we've had a decade of underinvestment in oil and natural gas. We continue to have reasonably strong growth in demand, and there's definitely some opportunity for some growth out of various different locations: Argentina, Brazil, Qatar. Now that it's left OPEC, but I would return to sort of my copper story, which is to say that if nothing meaningful changes, we're still looking at a situation where over the next 3 to 5 years, oil markets are tight. They're not oversupplied. The IEA came out with their monthly oil report a couple of days ago, maybe 2 weeks ago, and I mean, golly, they somehow managed to. I think the numbers were something like, well, we're going to produce 108 million barrels a day versus demand of 102. I don't know where this 6 million barrels of spare capacity or whatever it is they came from. I don't actually pay for their report because their track record is so unbelievably bad.
You're not the first person to say that.
Yeah, no, I'm sure I'm not. So I don't know where all that spare capacity came from. Will the spare capacity that was forecasted to be in the market this year, which was a very fine number? It was an extra million barrels a day, maybe, stuff like that. The types of numbers are well within the margin of error. And so I would call anything that's well within the margin of error when counting barrels, which is notoriously difficult, to just be a push. Where the market's trying to be precise when it doesn't even know if it's being accurate. I think the outlook for oil and natural gas is particularly good, albeit we will have sentiment-driven moments that could last several months, as this one quite likely will. They manage to stay in negotiations for 60 days, then the market for oil will soften dramatically. But I have trouble seeing us with oil now. I'd have to double check the chart, but at the very least, we're where we were prior to when the Iran war kicked off, quite likely below where we were. I have trouble seeing the market as less risky now than it was before. At a minimum, prior to the war in Iran, we would have had to have thought about the oil price and baked in some sort of very small percentage chance that the Straits of Hormuz gets closed. But now that it's been closed once, the bar to do it again has been lowered dramatically. The methodology for doing it has been crystallized. It's been tried. Iran knows how to. So at the very least, you have to bake in more of a risk premium associated with that going forward. So again, how the oil price has fallen to where it has, and whether that is rational or not, I'm highly suspect.
Yeah, I share those views. We're basically right back to pre-war levels, which assumes no risk premium. And there's a lot of risk premium that you could attribute to oil right now. We don't know what the tolls are going to look like, or if there's going to be tolls, the control of the Strait of Hormuz. And then just going back to your background on insurance, if you're underwriting a policy for a tanker, I got to imagine there's a new premium embedded into the policy based on the risk of the ship getting blown up or being stuck in the strait. What are your thoughts there from the insurance perspective if you step back into your old shoes?
I would tend to agree, and it's not Look, I will say I was credit and political risk. Hull Insurance is a different group, but we sort of sat next to each other, and they are related. And so I picked some things up over time. Uh, there are plenty of people who I would just imagine are just like, you want Hull Insurance for where? You want to go into Persian Gulf right now? I mean, really? I think our book, we don't need any more of that right now. We could just, come back to us in a couple of months. Maybe a good client comes around, and this happens, and this makes sense. Good client comes around, and look, we've been doing business with you for 10 years, and we've always paid our bills on time. None of our policies have gone wrong, and yeah, we need to get a tanker in there, and we need to get a tanker out. We need some insurance. Okay, fine, yeah, I'll write that policy. But that's not the majority of your clients. That's a small selection of your clients. Some guy comes off the street, wants insurance. I'll be like, forget it. It's just not worth. It's not worth the headache. It's probably not worth the headache in terms of paperwork that the risk management department is going to ask for, let alone the actual return. I would be surprised if much is being written in the grand scheme of things.
So taking what we've learned from the Strait of Hormuz being a political lever, we've got new export restrictions, China restricting some of their rare earth exports, a growing U.S. critical minerals list, more frequent supply shocks. Go back to Russia's invasion of Ukraine and the shutoff of gas to Europe. There seems to be a growing resource nationalism theme. And under that regime, do you view the world a little bit differently as an investor today, maybe versus, say, 5 years ago?
And I will add, you missed an important one. There's not only a resource nationalism theme, there's an AI model nationalization.
Yeah,
nationalism
good call out.
Right. And I bring that up not because I find that one in particular to be significant or more significant than any of the others, but because it demonstrates the breadth at which this drive for security and for freedom of freedom of activity, if you will, is being put. Every day, we see countries that are making an effort to increase their independence from everyone else. And it is broadening into more areas of the economy. It is not shrinking. And that is critical. From my perspective, this is sort of why this concept that I talked about at the beginning of political economy as opposed to economics and politics is so important, and why thinking about the world through that joint lens is so important. It is another risk that the market is either not pricing or prices quite poorly. That sort of second one is very much true. There's nothing the market handles more uncomfortably or with less surety than political risk. Yet it is proliferating as we speak. Every day, almost, there is something new. And so again, that has a impact on dispersion. That has an impact on results of companies. There are going to be companies, whether we like this or not, and I'm uncomfortable saying this, but there are going to be companies that do better because they have a better relationship with governments. And while that may be a moment in time here in the United States, given the current administration, although I don't think so, it is absolutely not a moment in time in most other countries, especially fast-growing emerging economies. Whether that be Africa, Latin America, Southeast Asia, that is an operating sort of standard operating procedure in those countries that they are only doubling down on. And here in the United States and in Europe, we are now, increasingly moving towards that type of industrial policy. And certain places are already clearly ahead of the curve. on that. U.S. industrial policy is moving very fast, but in places like Europe, they already have some national champions, right? Like you think about Airbus. Airbus is the European aerospace national champion, right? Rheinmetall is increasingly becoming a defense national champion, right? They've gobbled up a shipping company now. They've gobbled up or a shipbuilding company. They've gobbled up a tank manufacturing company, right? So this drive towards national champions, towards heavy industrial policy, towards linking national security with economic strength. These are things that are only going to increase with time, at least for the foreseeable future, and increased dispersion of results at companies, which means that there's an ever greater opportunity for someone to come in and make thoughtful stock picks about management teams and business models and companies.
Right. Certainly a fascinating time. We're running out of time. So I want to throw one more question out for our listeners that want to learn more about your fund and views on the market. Where can they find you? And then selfishly, I got to ask, when can we expect your next investment letter, which I highly recommend reading for any of the listeners out there.
Well, I appreciate the opportunity to just sort of share my fund with people. You can find us at www.massifcap.com. That's massifcap.com. On that website, you'll find all our past letters. You'll also find a link to a blog that we write that shows investment reports and things of that nature. About once a month, we put out a big report. And in regards to our, and anyone can sign up for those things. They're distributed sort of to anyone. And in regards to our next letter, I've started thinking about it already. My guess would be July 10th is my target. Now, my guess is it probably will be July 17th.
Yeah, I know how that goes. Publishing research.
Yeah.
It always takes longer. Well, thank you so much for sharing your thoughts in insight into such a unique market right now. Really appreciate you joining us, Will.
Absolutely. Thanks for having me.